The big question of the day, could the CARES Act cause inflationary concerns to our retirement wealth gap? Hey friends, I'm your host, Justin Goodbread. Today we're going to look at inflation, but we're going to look at it in this light of the context of the wealth gap. As you know, we've spent the last few episodes talking about this important calculation, that shows us how much further we have to go in this journey of creating wealth. Ultimately, we talk about we're standing on one side of the river and we're looking across the riverbank and we're looking to the other side and we're saying, okay, how do I get from one side to the other? And we use this idea that I live on the Tennessee River, right on the river. It's about a mile wide where my house is at. And we can go down to the riverbank and look to the other side and say, I know exactly where I'm at this moment. But how do I cross this river? And we use that as an analogy saying that I know financially where I'm at today. I do. But I need to get to this other side. I need to reach this destination that's going to allow me to reach my, quote, retirement goals, my accumulation goals, whatever your goals may be. But as we make a journey across this river, this metaphoric river between now where we're at financially and where we're going to be in a few years, there's a lot of things that can adjust us. If I were going to get into a boat and row across the river where I'm at, roughly this mile-long river, there's actually a slight current. And unless I adjust for the current, then if I'm looking at a particular destination on the other side, let's say a dock on the other side of the river, if I don't adjust properly and row properly and use some counter maneuvering to offset the current, then I will never reach my destination. I will cross the river, but it may be further than where I wanted to be from. It may have cost me longer time because I didn't anticipate the amount of effort I was going to have. So as we look on this metaphoric journey, there are a few things that we have to talk about in relation to the wealth gap. And one of the first things we deal with is inflation. Inflation is one of these things which could cause us some serious harm in our retirement gap or in our wealth gap. So let's talk about inflation, but let's look at it in light of COVID. Now, if you think about COVID here in 2020, the CARES Act, man, what an amazing piece of legislation, $3.6 trillion roughly in additional government spending that took place because of the COVID-19 that transpired. In fact, the Federal Reserve balance sheet ballooned from $4 trillion in mid-March to roughly $7 trillion when they passed the CARES Act and some other funding that came about. In fact, now it's a little bit higher than that because of the way that debt works. Now, the latest projection from Federal Reserve policymakers show that they're trying to keep it at 2% over the next 2 years. That's the inflation. That's what they're trying to do, is a 2% inflationary trend for the next couple of years. But nonetheless, the CARES Act and some of the other stimuluses that we've seen this year have been the largest stimulus within our living lifetimes. There's not a person that's living at this point that has had larger stimulus per GDP than what we've dealt with right now with COVID. It's been amazing. Now, there's some packages in times past which are comparable. If we look at some of the things that transpired with whenever we had, oh man, my mind just went blank. 2008, there was a little bit of stimulus there. 2014, a little bit of stimulus there that happened through time period in the most recent history. If you go on back, they got the New Deal that transpired. There's a lot of different stimuli that have transpired in our government's history, but none, 3.6 trillion with a T. I mean, I can't even fathom that much money. I mean, I can barely handle a million or a billion, but when you get to the trillion, it's ridiculous. So let me give you some ideas on how big this CARES Act was and why it does have a direct impact on how we deal with our specific wealth gap. The government spending as of right now projected for the fiscal year 2021 from this month as we're recording this in mid-September till next September is $4.829 trillion. $4.829 trillion. Think about this. The one stroke of a pen that transpired with Congress, both the House and the Senate and our president, a mixed political bag. It was both Democrats and Republicans that pushed this through with a high voting passage. Signed $3.6 trillion in additional debt. So if you're looking at an annual budget, we're at $4.8 trillion. $3.6 trillion was signed with a stroke of a pen. That's in addition to our annual fiscal budget. So roughly 20.7% of our annual budget is dealt with by the Office of Management and Budget Reporting. Now here's where it kind of breaks down. 2/3 of our budget goes toward manual programs or mandatory programs such as Social Security, Medicare, and Medicaid. 2/3. So out of that $4.8 trillion, 2/3 of that money goes towards Social Security, Medicare, and Medicaid. That's amazing to me. What's more amazing is the debt payment that we have on our for the next fiscal year, 2021, is $378 billion with a B, $378 billion in just debt payment because of the current deficit or current debt. So when we look at what's happened this year with the CARES Act, we have had unbelievable high record spending. Well, certainly, most people anticipate that's going to lead to some sort of an inflationary increase. Now, is it a promise it's going to increase? Absolutely not. But most people believe that because of the amount of spending that we are going to see an inflationary increase. So that leads to the question, what is inflation? What is inflation? The simplest definition I could find says this: inflation is the rate at which general levels of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. Let me say that again. Inflation is the rate at which the general level of prices for goods and services is rising, while simultaneously, it says and consequently, but while simultaneously, the purchasing power of the currency is falling. We're going to give you an example on that. I'm going to use a cup of coffee. A cup of coffee. Now, whenever we track these type of movements, we're looking at the CPI, or the Consumer Price Index, and some people look at the WPI, or the Wholesale Price Index, when you're looking at this. But in 1967, I found this interesting because I was drinking a cup of coffee. I don't know about you. Hey, leave me a comment below whenever you listen to this. Maybe hit me on Twitter or Instagram or Facebook. What is your favorite cup of joe? I mean, do you like Caribou coffee? Are you a Starbucks person? Are you a gas station? I mean, are you Stump Water? Give me some Folgers in a cup. I mean, it's the best thing about waking up, right? What type of coffee do you like? So I was having some Dunkin' Donuts coffee the other day. I will tell you my favorite type of coffee is I like Caribou coffee, the dark roast. I just like the way it tastes. Or some of these micro roasters. Emily and I will take and we grind up on coffee beans every morning. We put them into a French press. That is my favorite type of coffee. I just love it. But anyways, in 1967, the average price of coffee for a cup of coffee was 38 cents. So 38 cents for a cup of coffee. Now, if you go to Starbucks today, it's not 38 cents. I mean, if you just get a black cup of joe before you get all the frou-frou stuff in there, the way coffee should be, can I get an amen there? Black and strong. Don't get any of that other whippy stuff inside there, that whipped cream and the creamers and all those other sugar. Just give me a black cup of coffee. Anyways, it was 38 cents in 1967. According to the Bureau of Labor Statistics, prices for coffee was 630% higher in 2020 than 1967. 630% higher. So in 1967, you bought a cup of coffee for 38 cents. Today, the average cost is $2.40. That's the average cost. Now, your cup of coffee may be lower or higher depending on where you purchase it at, but that's roughly the difference. If you extrapolate it out to an annual rate, it's 3.82%. It was the average inflationary rate for coffee. Now look, gasoline has a different inflationary rate. Healthcare, my goodness, we've seen how healthcare spiked because of inflations. School, I mean, whenever I went to college, long time ago, 20 years ago now, college was not near as expensive as what I'm looking at now for my daughter to go to college. I mean, it's just ridiculous, the price of school. We look at the price of gas. I use this often. I can remember buying gas for my lawnmower whenever when I would push it down to the gas station, fill it up back in the day with regular unleaded gas, none of this ethanol stuff. And I think it was like 47 cents a gallon. It was ridiculously cheap. But I can also remember not too long ago, there was a gas shortage, and I remember filling up the old diesel engine that we have in our Excursion. My family drives an Excursion, and it was almost $400 to fill the Excursion up. It has a huge tank on it. It was like $5 a gallon almost. So I don't know where you're at right now. I mean, right now with the United States exporting the largest exporter for fuel, our prices have dropped significantly. But I mean, coffee, think about it. 3.82%. It was 38 cents a cup, and now average would cost $2.78, or roughly $2.40 a cup. $2.40 different, $2.78 a cup. That's crazy. That's crazy. So there are times whenever inflation causes problems for us. The power of inflation. Here we are in 2020. We're not talking about when going back in time, we can't go back and get prices. What we can track is the power of our buying dollar today. And just interestingly, the Bureau of Labor Statistics just released not too long ago, just in the last week, some statistics for August. And I want to read some things to you. The inflationary rate from the U.S. increased 1.3% in August of 2020 from 1% in July, being the market's forecast by 1.2. So that's saying that we had an inflationary increase of roughly 0.3%. It's the highest rate since March. It's unbelievable. You look at the cost of cars and trucks. They rebounded from 4% versus a negative 0.9 in July. So because of COVID, we ended up having a buying, it's almost a stop. We closed our economy off because of COVID, printed a bunch of money, and people began not spending dollars. So that caused a deflationary trend. Not quite, but it caused the prices to drop. Well, now they're starting to move back. The prices for new vehicles increased faster at 0.07 versus 0.05 for the previous month. It's moving around. The price of energy dropped less. So energy costs have been going down through this COVID situation. So there's what's called a deflationary trend, and it dropped negative 9%. The inflation for food went up 4.1. It went up for shelter 2.3. For commodities, it was 0.8. For medical services, it was 5.3. I mean, listen to these numbers, friends. 5.3 in medical services. The deflating dampening in the apparel industry, it went down negative 5.9, and transportation services went down negative 4%. That's crazy. So you have things that transpire. Whenever inflation happens, almost simultaneously, you can have a deflationary trend, and that's what we're looking at. Justin, what in the world are you talking about? Look, prices are going to increase. Prices are going to increase. I've got a chart here that we'll share with you on the blog, financiallysimple.com. Check it out. It's where we put all of our data for the podcast. There's a blog that correlates with each individual podcast, so that way you know the information I'm giving you. I have cited and sources for everything. I don't read you everything here, but here's an interesting one from the Trending Economics that talks about that the average inflationary rate over time is around about 3.8% if you're looking at it over a long period of time. Now, in the most recent future, it's been relatively low. It's been relatively low. Whenever I grew up, my Big Ma is what we called her. She was my great-grandmother. We called her Big Ma. She was Cherokee Indian. Oh, man, great woman, great woman. In fact, at age 81, she was still on top of her house, sweeping it off with a broom at age 81. We had to tell her, Big Ma, you can't climb on top of your house with a broom at 81 and sweep off your house. Can't do it. But nonetheless, she was a spry lady. She had this cuckoo clock in her house. And on this cuckoo clock, it had this pendulum that would swing tick, tock, tick. I mean, you've heard those. The tick-tock, they would go back and forth on this pendulum underneath this cuckoo clock. And every time it would hit the 15-minute or 30-minute or 45 or an hour, the cuckoo bird would come out and do his cuckoo. And at an hourly chime, it would do three cuckoos, if I can say it right. If it was 3 o'clock, or I don't think it's three cuckoos, I think it's three coos, if I can say that right. But anyways, every time it hit an hour, the bird would come out and do its thing. And so as a kid, I loved watching it. But I want you to think about that grandfather clock, because in any part of finance, just like in politics, just like in sports, anything else, whenever the pendulum swings to an extreme on one side, it often swings back to an extreme on the other. Now, that length of time, that travel time from one side of the pendulum to the other side of the pendulum could take 10, 15, 20 years. Sometimes it moves much more rapidly than that. We see it in politics where every 8, 10, 15 years, you had the pendulum swing from one side to the other. Sometimes it's more rapid. We see it in sports where like my Atlanta Braves, they were on top of the world in baseball, and now not so much. One day my Bulldogs are going to be back on top of the world and actually win a national championship. I can't wait till that happens so I can give my Tennessee fans here, my friends here in Tennessee, a hard time. They're going to say boo at that point, but I can't wait for my Bulldogs to win a national championship because the pendulum will swing at one time or another. But whenever we've had a low inflationary trend for a period of time like we've had for the last 10, 15, 20 years now, roughly, there will be a time when that inflationary trend is going to flip the other way. So how do we deal with inflation? And why am I making such a big deal about it? Because in order for us to close the gap in our wealth, in order for us to reach our goal of where we want to be on the other side of the river, we have to know the speed at which the current is flowing. We have to know the pressure we're going to fight in this journey from here, where we're at today on this side of the river, to close the difference where we're going to be on the other side. And inflation is one of those powerful things that ends up causing us to derail or get off track. But what do we do about it? Well, we invest in things which outperform inflation. So we don't leave a lot of money in cash. Cash, you know where my position is on cash. I believe that we business owners should have an emergency fund at home and an emergency fund in our business. In fact, now more than ever, I can get more people to agree with me on that because of what's happened with COVID. Because of my position that I have, and I've been teaching business owners this for years, that we need to have a significant portion in cash. Our business owners who followed, they actually made money through COVID. We're able to invest in things which provide them more income and better position for their business, and actually made a profit. Those who didn't have cash, they were scrambling. So, but you don't invest in cash long term. We want to keep the proper amount of money in cash and no more, because cash is the safest way to lose money. It's going to get eroded by inflation year after year. The dollar to purchase a cup of coffee today at $2 in 10 years is not going to be $2. We've used that in our example already. Remember, it was 38 cents and now it's mid $2.75 or 78 cents. So what do we invest in? Well, equities, stocks, they could outperform inflation. Historically, they have. But they could outperform inflation. Real estate, it could outperform inflation. But both of those things could outperform inflation. Your business should outperform inflation. So I give you this to say, as we're looking at this journey, this gap, we have to make sure that our assets are yielding the returns post-inflation for us to bridge the gap. What do you mean post-inflation? Well, we have to adjust our growth assumptions. So whenever people, and I've seen people do this, especially with business owners who think we can DIY it ourselves and we don't need some financial guy to help us in this world. I've seen a lot of people run their calculations and they make these gross assumptions. They say, okay, I believe that I'll get a 10% return. Let's use a portfolio for a hypothetical situation. Again, this is not a promise. This is just an example. I cannot tell you what a portfolio is going to return going forward. No one can, okay? But let's say we think our portfolio is going to yield us 10%. So we have $100,000 today and we're going to deposit $10,000 a year. And with a 10% return, boom, now we've all of a sudden got X number of millions of dollars out into the future. Great, I've met my goal. Here's the problem. We don't calculate inflation into our assumption. So let's assume that we make 10% on our return. But now inflation, let's say, is 4%. Let's just say we use an average 4% for the next 20 years of our lives. That means we only got a 6% net return in our growth. A 6% net return in our growth. So you see, if you don't understand the current, if you don't understand the pressure you're going to face as you paddle your boat, swim, whatever you're going to do to get to the other side and building this metaphorical wealth gap, if you don't calculate it correctly, then you could have false assumptions. And what happens so many times, friends, in fact, I was just dealing with this today with an individual I was talking to via email, is we get out now to age mid-50s, 60s, maybe early 70s, whatever that age is for you. And we're like, I'm done. I waved the white flag. I'm out of here. Just forget it. I'm done. We wave the white flag and we realize we're nowhere near the amount of money that we need to meet our goals. And we're forced to make hard decisions. We're forced to say, how much am I going to adjust my goals? How much am I going to adjust my lifestyle? Do I have to downsize the house? Do I have to take more risk in investments? Do I have to work longer? See, and I'm just saying we don't have to fear that. If you go back to the episode we had on fear, one of the biggest fears we have is, are we doing the right things at the right time? Are we going to be okay? We know we have a concentration risk within our businesses. We know that. The last thing we want to do is have these fears that we already recognize and not give credence or not identify those things which are going to cause us harm as we're going about on this journey to close our wealth gap. Remember, the wealth gap, once again, we're standing on one side of the river, we're looking across the other side, and we're trying to figure out how we're going to close the difference. And so the way we're going to close the difference is using proper investments. But there are going to be some things that combat us. One of them is going to be inflation. If we understand that the prices of goods and services are increasing at various rates, as I identified earlier, you had housing increasing at one rate, healthcare at a different rate, fuel at a different rate, goods and services at a different rate. I mean, they're all moving at different rates at different times. If we recognize that, then we realize we have to do something. We have to do something. So here's my trailing question for this particular episode. Do you know the average annual return on your business?